Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always, Shruti Mishra. These are the top headlines from the startup world. HR tech company People Strong has sold its assessment and remote proctoring business, WeBox, to global non-profit educational research and measurement firm ETS. The acquired business will continue to operate independently as a majority-owned subsidiary of ETS. Linen management firm Quick Smart Wash raises $5.15 million from Japan-based Elan Corporation. The funds will help the firm expand capacity from the existing 35 tons per day to almost 55 tons per kg per day within this financial year. Omnichannel meat retailer Licious saw its losses for FY23 narrow by about 38% to 528.6 crore rupees from 855.7 crore rupees a year ago. Revenues grew 9.5% to 747 crore rupees as per data from TOEFL. Microsoft CEO Satya Nadella is expected to testify on Monday as a witness for the US Justice Department in its legal battle against Google. Government is likely to ask Nadella about Microsoft's efforts to expand Edge and Bing and the obstacles posed by Google's dominance. Apple staff met with Chinese officials to discuss concerns over new rules that will restrict the US tech giant from offering many foreign apps currently available on its app store in the country. The Wall Street Journal reported the officials told Apple that it must strictly implement the rules which ban unregistered foreign apps.
Well, those were the headlines we are tracking for you this evening. Fintech unicorn Cred has forayed into the vehicle management space with Cred Garage. The feature is live within the Cred app and will be rolled out gradually across the member base. Cred Garage offers a single dashboard for services like concierge, parking, document management, and even insights on spending and much more. To elaborate on this new business segment, joining me now is Kunal Shah, the founder of Cred. Kunal, welcome to Startup Street. First, tell us what made you launch Cred Garage, what is the pain point that you're solving, and the kind of impact on the balance sheet you hope to make with this personalized vehicle management platform. Do you see it attracting new users?
Cred, we've always had this belief to focus on a certain set of customers which are credit-worthy and figure out a way to reward good behavior. We started with focusing on financial behavior, paying your bills on time, paying your credit card bills on time, maintaining good credit score. And we want to extend this to more dimensions of life. We believe that if our members demonstrate good behavior, it should create more frictionless experiences for them in terms of every other interaction that they do with the external world. And I think we've been quite successful in doing that in the financial services space. We believe that the members, while we define companies in terms of fintechs and non-fintechs, consumers don't define apps in these labels. We are building a community, and our community wants to focus on rewarding good behavior and creating frictionless experiences. In terms of will it create new users for us? I think there's a significant overlap between customers who have a credit card and who own cars. And we believe it's going to be quite a complementary segment in terms of growing the base. But I think when members see more benefit for using an app across multiple dimensions, it creates more reasons to come, more reasons to stay. And we believe that it will kind of continue to grow from here.
Okay. All right. Now let's talk about Cred Garage. It is available to all members and you've already started with the rollout. It offers a whole host of offerings, Kunal, for its users related to managing and maintaining a car. But you do have some competition. There is Spark Plus that has already made a significant presence in this space. So tell us what is unique about your offering.
I think a lot of us are building companies on public infrastructure that is available, and thanks to all the digital public infrastructure that's been done by the government of India. And I think consumers will obviously use more than one app to experience these products, and everybody will have a different take towards it. Our view is that consumers manage already their cars, their bills, their credit cards, and eventually if there are more things that we can allow them to kind of manage and create good experiences, we become a more horizontal offering versus kind of focusing on a category. I think it is a space that is evolving and kind of differentiating on the key offering for us has been kind of combining all of these things in one place, allowing seamless transaction experiences, allowing our members to experience just frictionless experience to use this in one app.
Okay. You've also tied in a few financial products within Cred Garage. Users can recharge their fast tag, and you also offer garage users the option to buy motor insurance. If you could take me through some of the partnerships you've built with Cred Garage.
So Cred has fundamentally built on the principle of partnerships. Even when we have done anything to do with financial services, what we do is we partner across PFSI and offer these services on our platform and create a good experience for both the partners in terms of being able to select positive selection of customers, more credit-worthy, more well-behaved. In terms of good driving behavior or good financial behavior, we want to kind of focus on good segment of users. And in terms of our FASTag and partnership, we work with multiple insurance companies. We have just launched with a couple of them, and we hopefully will do more partnerships as we progress. But quite excited about this, and we have seen very good response from even OEM brands, insurance companies, other categories who are keen to offer services on our platform.
What is your monetization strategy going to be with Cred Garage, and what will be your top performing segments going forward?
I don't think our market share has shrunk. I don't know how it was being measured when it was reported by some but we can keep that aside. But I think we are consistently on a 35-37% market share and growing from there. And the average UPI transaction will go down because earlier we did only credit card bill payments, and now we allow scan and pay P2P, which will automatically have an impact to the average order value. However, having said that, our AOV still remains significantly higher than the market on other UPI apps.
Okay, very quickly, one final question. Cred's losses are at over 1,200 crore rupees as last reported. Kunal, what timeline have you set for yourself to go in the green?
Every internet company which focuses on distribution first invests a lot of capital to build brand, create distribution, and kind of cross-sell over a period of time. As an internet company, we have a lot of support from our investors to kind of focus on creating good experiences and invest well in this category. What we have, however, noticed is that our customer acquisition cost has significantly fallen down. Our growth on revenue monetization is kind of significantly accelerating. I don't think we are working backwards of a timeline. We have support from our investors, but I think the trend lines are extremely positive.
Okay, so the trend lines are extremely positive. And on that note, we'll have to wrap up our conversation. Kunal, many thanks for joining us on Startup Street, and wish you the very best with Cred Garage.
Thank you so much, Shruti. Bye-bye.
So that's their new offering, Cred Garage. Now, Betterplace has put out its Frontline Index report for 2023. Ritu Singh joins in with the co-founder, Praveen Agarwala, to highlight the key findings of the report. Take a look.
The latest Frontline Index report released by Betterplace shows that frontline job creation fell by 17.5% in FY23, with only 6.6 million jobs created, down from 8 million in FY22. The average monthly attrition rate also went up to 15%, whereas average salaries dropped by 4.5% during the year. Karnataka also became the highest contributor to frontline workers' supply, replacing Maharashtra, which was earlier the highest contributor. Joining me now to discuss this report and its findings is Praveen Agarwala, the co-founder and CEO of Betterplace. Praveen, welcome to Startup Street, and thank you very much for your time here. Praveen, a significant fall in the jobs that have been created in FY23. What led to this kind of reduction?
I think overall, if you see from 8 lakh jobs, we have come down to roughly 6.5 jobs. These are the new demand that is created, right? Largely driven by the macroeconomic environment where there were cuts in terms of investment. The growths were kind of sluggish compared to last year. But overall, I think this will come back very fast. Perhaps the festive season is coming, and after that, we believe the economic situation are looking much better than what it was. But it was largely driven by that. And second is that there was a huge surge after COVID. So that was also playing in the growth phase. And now it is becoming more, I would say, sustained growth going forward in the same manner.
Logistics and mobility, which is now the highest employment generator, is nowhere close to what e-commerce was employing in terms of share. How do you see this playing out over the next few years? Will the share of e-commerce get even smaller as enterprises look to variabilize their workforce costs?
Overall, e-commerce has gone down. It's also because, as I said, that there was huge surge that happened in 21, 22, and that is now playing down a little bit. But this is, again, keep in mind that this is drop in demand. This is not losing job, right? So people are still hiring, right? The second thing that we are seeing is that a lot of organizations, because of funding winter and growth capital being slowing down in terms of what it used to be last year, everyone is looking at efficiency. And that's the reason we believe the great variabilization of cost is coming in, where everyone is looking for more gig workers, which is just in time, rather than having people full-time in deployment. And these are the two reasons why there's a drop and variabilization. But I also believe with the festival seasons coming now, with big billion days and everyone is going for shopping, buying things, there will be a surge in hiring.
Let's talk about the salary though as well. That decreased by about 4.5% during the year. And interestingly, this was lowest during the month of September as well as March. What explains this, given that September is the start of the festive season where one would imagine the demand would spike and hence so would salaries?
Everyone is looking at how to manage the cost right now, Ritu. So people are looking at revenues to cut down on the delivery cost. You look at the cost of, so everyone is thinking in the terms of profitability, right? They're cutting down on the discounts. They're also cutting down on some of the salaries. They were also paying higher when the demand was growing rapidly last year. And when it slows down a little bit, you start cutting down on the corners as well, right? So that is one reason. I believe you will see a higher salary coming up in October, November. Overall, we will see this kind of trend for next 12 months to 18 months is my strong belief, till we have a new minimum wage program coming in.
Where are the sectors where this gender gap is being bridged better than the others, and how do you expect this to move in the coming years?
So first of all, this is a 100% increase from what we saw last year, right? So it was 3%, today it is 6%. Yeah. And I personally believe it will continue to grow and might be at a stable state. It will be around 20-25%. There are 2-3 reasons for that which are driving it. Number one is every organization is looking at more efficiency and productivity, and everyone believes very strongly with a good gender mix, with women coming in, the productivity goes up. So that's one driver. Second is, of course, ESG plays a huge role with social and governance. Third is the gigification or the variabilization actually gives more flexibility to the women workforce so that they can actually pick up work at their suitable time, right? So they can do, I strongly believe by 26, 27, which is like 3 years from now, we will see at least 20% of women workforce.
What are the trends that you've already seen so far in the year, whether it is job creation, salaries, and so on?
I think there are 3 things which are happening. Number one, variabilization, which we spoke about. Number 2, I think skilling will take a center stage. With China Plus One happening, a lot of opportunities coming here in manufacturing sector. Everyone is looking at AI and other stuff. People are looking at higher income, so skilling will take a center stage. And third, I strongly believe there will be people migrating as a family from lower middle class to middle class, or people moving from blue collar to gray collar, and that will be driven mostly by technology. I strongly believe that out of the 5 trillion economy that we want to have, 700 odd billion will be created by this economy in next 3 years or so.
Praveen, thanks very much for your time here on CNBC-TV18. Always a pleasure speaking with you.
On that note, it is time for us to head into a short break. But coming up next, college enrollment and learning marketplace College Dekho has acquired ImaginXP, a Jaipur-based startup providing content and curriculum delivery services. We bring you that exclusive and more on the other side. Stay tuned.
Yeah, inorganic sort of has been a fairly integral part of our growth, and this is our third acquisition in this space. If you know a little bit about college space in India, right? So
Welcome back. You're still with us on Startup Street. Onto a CNBC-TV18 exclusive college enrollment and learning marketplace. College Dekho has acquired ImaginXP, a Jaipur-based startup providing content and curriculum delivery services. Now, with this acquisition, College Dekho will be able to offer the entire spectrum from enrollment, curriculum, content delivery to career services to universities as well as students. It aims to bridge the gap in employability skills and provide skills that make them job ready. Joining me now to elaborate more on the acquisition is Ruchir Arora, the co-founder and CEO of College Dekho. Ruchir, thank you so much for joining us on the show today. Inorganic growth has been quite a big part of your growth plan, and you've recently acquired ImaginXP. Give us some contours of the deal. What was the deal size?
yeah, inorganic sort of has been a fairly integral part of our growth, and this is our third acquisition in this space. If you know a little bit about college space in India, right? So we are the largest college-going population in the world. We are also sort of maximum number of colleges in any country. So we have almost 56,000 degree granting colleges. What ImaginXP and College Dekho were essentially doing, they were helping these colleges teach the kids better. Yeah. And we keep hearing these numbers about 50% of Indian graduates not being employable, 75% of engineers not getting the job in the first year. These guys essentially add these courses which are very job oriented. So the courses in design, courses in technology, essentially helping these colleges making their curriculum better. The deal is actually less than $10 million. I can tell you one thing that we've acquired them for some time, and this business, which we sort of just launched, which is helping colleges teach the kids better, is our fastest growing segment. The three companies put together that we acquired have grown almost 10x in the last 6 months.
Three companies that you've recently acquired has grown 10x in the last 3 months. But also tell us, how much do you expect ImaginXP to add to your growth? Any more companies that you're looking to acquire, and how well funded are you for these?
Yeah, so let me answer the second one first. So, higher education is essentially unlike K-12, where there's a lot of investor money went. Higher education is probably one of the most underfunded category when it comes to education, but it is actually bigger than K-12, but it is also very underfunded. The reason being, our businesses, especially our business model, where we help students get into college and then make the colleges teach them better. It's essentially very cash-rich business, right? We operate at almost 80-85% gross margin. So we've actually done only one institutional round, close to about $35 million, which is about 2 years back. And we still have half of that with our bank. So we haven't sort of spent a lot of that. Interestingly, we have actually grown 4x. So I think this financial year, we should close close to about 300 crores in revenue, in net revenue. We expect to keep growing. This business is going to add close to about 20% of 15-20% of that in the coming year. But we think that this entire enabling these colleges to teach these kids better is going to be a fairly large chunk of our business going forward.
All right. Talk to us about the kind of growth in demand that you've witnessed from last year, and where are you seeing most of the traction coming from?
the demand essentially, last time we spoke, we had just acquired a company called Get My Uni, which was essentially in a similar space that we are, helping students with the right college. We've essentially seen the demand grow almost 2x. And one very interesting number, I'm going to tell you that last year, close to about 10 million students took admission in colleges, 1 crore students took admission in colleges. Almost 45 lakh went through our platform. Actually, they submitted inquiries on our platform. So we are essentially capturing almost 50% of the demand by going students. And this is all on the back of amazing word of mouth. We essentially see that the higher education segment is one of the segments which is growing, because we are currently at about 27% GER, which is sort of fairly low. The government has taken initiative to make it to 50%. So I think the demand is there. Now, essentially, we need to add more sort of layers of business which can help monetize the demand better.
All right. And what about profitability? When will you turn profitable? And what are your current revenues? And when will you be able to turn profitable?
So, the good thing is that in the last and this quarter and the next quarter, we are already profitable. We are actually, EBITDA positive. Hopefully, we'll continue the same journey. We as a company make sure that the growth is essentially sensibly done, right? So we are not one of those companies which has grown 500% and then came crashing down 200%. We've been growing 80-90% year on year and decently profitably. It is up to us to push that growth and go into a negative territory. But till now, we've essentially maintained a healthy growth as well as profitability.
So healthy growth and profitability. But Richard, before I let you go, where do you see the next leg of growth coming from? Any new offerings on the anvil at this point?
Yeah, so I think we are now sort of going to sit back and consolidate some of these things. We've actually done a few sort of acquisitions and added a lot of offerings. But as I said, our core ethos is we think that the reason for some of these news items, etc., where people say that kids are not employable, are essentially twofold. One, we are sending everyone to colleges to become an engineer, which is not the case, right? You have other categories which essentially need people, but we don't have enough people. So first part of our business is help kids discover themselves and the right college, right? Which essentially has grown very fast. In the last 4 years, we've grown almost 7-8x there. This year, we'll end up doing close to about 250,000 applications through our platform, close to about 80,000 admissions. The second leg is how do I make sure that these kids who are going to these smaller financially challenged institutes, enable them to teach these kids better. So these two legs of our business, we're going to consolidate, and this is where the growth is going to come back. One thing that we want to do is that right now we've added, as I said, we help these colleges with management, tech, and design courses. We want to add more courses to our anvil. Especially, we are seeing a lot of demand in the healthcare sector and how the healthcare sort of courses are being perceived.
All right, Ruchir, many thanks for those details. But with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side.